Hello everyone and welcome to Pearls of Fisdom with Nirmal Bang. I'm Avan Dabash. Well, today we put the spotlight on the primary markets. It is no surprise and every headline that you read is talking about the big IPOs, Ola Electric, Swiggy, PB Fintech, you name it. There have been so many companies that have had a healthy listing. You can attribute it to the easing inflation, the stable interest rate environment, or the fact that the stock markets have really been rewarding investors. In fact, the amount that has been raised from the initial public offerings or the IPOs so far this year has crossed 1.19 lakh crore rupees. That has surpassed the previous record that was set in the year 2021. So let's discuss the IPO frenzy and investing in startups. Arjun Vaidya is the co-founder of V3 Ventures and now joins us on Pearls of Fisdom. Arjun, good to have you. Given that the IPO fundraising so far is the second highest that we've seen globally in India compared to the US, take us through how you're just looking at the overall environment right now.
Yeah, so maybe I'll start with a macro context. I think since 2020 or 2021, there has been a tectonic shift in the amount of capital flowing into the Indian ecosystem. I think we were always considered an emerging market with a lot of promise, but yet one to deliver. And then when sort of this time period hit, COVID came, I think there is a slowing down of growth in the Western world, whether it's the US or Europe. China, given political climate and political reasons, has now become a no-go for a lot of investors. And so that capital, that FDI, that FII, that global manufacturing hub creation is happening in India. I think with that, it's definitely benefited the startup ecosystem because there is now an increased interest globally in capital flows. A lot of that Asia capital that was going to China is now coming to India. But I think what's clearly different today is you are seeing now large venture capital, large private equity funds being raised with completely domestic LP pools. Now, India as an ecosystem has not been as exposed to the startup, venture capital, early stage investing as maybe some parts of the West. But I think given the traditional nature of our family offices and the way they have invested in the past, seeing our companies like Zomato, like Nykaa, like Paytm, like Policy Bazaar, like Swiggy going to IPO now, gives these more traditional investors who have traditionally invested in listed equities a lot of comfort that there is an eventual end game that these companies will deliver. They will eventually show profitable metrics. They will eventually show a strong P&L. And these companies have actually shown that with the IPO, the final outcome is also liquid. And so the proliferation of startups from seed stage to IPO, and there are enough examples now in India, is a very, very important sign on domestic capital and additional domestic capital entering both the startup market as well as people interested in investing in startups who were fearful to invest because these were unlisted equities with no liquidity profile, to eventually invest in them through the listed market or through the pre-IPO market as well.
Sure. So I bet a lot of retail investors say, hey, that was a great IPO. I want to get in on it. So what exactly is the prerequisite, especially when it comes to investing in startups?
I think it depends what stage you're investing, but assuming that an investor is coming in at the early stage, I think I've said this many times before, I think keeping a corpus of capital that allows you to diversify risk across multiple companies is crucial. What that means is that you may have lots of conviction on a specific asset, but given that it is a startup and that 90% of startups or 95% of startups fail, you need to diversify this risk because you never know what could happen. It could be a regulation change. It could be a new competitor entering the market. It could be your competitor getting too much funding. It could be change in market dynamics, change in what consumers want. And so it's not necessarily the founder making the mistake at every single point of time. And so what I tell people is at least have enough capital or corpus that you can invest in 10 to 15 companies. This also means that you should be able to have that amount of deal flow. Now, in my industry, and I operate as a VC, we invest in less than 5% of the companies that we meet, which means you need to be able to create the funnel of meeting 200, 300 companies if you want to make 10 or 15 investments. And creating that funnel is very different from the listed markets where you can just run a screen basis certain parameters and get the list of companies and have access to these companies. I think access and asymmetry of information is a characteristic of the startup ecosystem. And so figuring out what the right networks are, what the right people are, what the right access is to be able to get that deal funnel is crucial. The last thing is that you've got to understand what good decision making is in this asset class. And so before making an investment, at least view 30 or 40 pitches, because I was very trigger happy when I started angel investing or startup investing, in that you're meeting these amazing entrepreneurs who are very passionate about what they're doing. A lot of the businesses, you have not operated in those industries. And so with the passion that you see from the entrepreneur and the story being sold to you, everything seems good. Today, I'm not an AI expert. And so any company pitching anything in AI to me seems game changing. And so I think you've got to be able to go through that rigor of seeing 30 or 40 pitches without making an investment to start to ascertain what's good and what's bad.
And what role do financial metrics play? Revenue growth, burn rate, when you're evaluating a startup's viability? How can investors actually interpret these figures effectively? Because I think a lot of them really struggle with understanding the valuation of these early stage companies.
I think there are three metrics that I would look at the early stage, and the one that you talked about is the third metric. But I'll start with metric one. You've got to be able to be a great judge of people, and about 50% of my decision goes on the founder. Who is that person? Why do they have a right to win? Why do they have tough times? I think the second numerical or monetary metric is the market. While I may be building a beautiful product, the market has to support 10x, 15x, 20x, 5x, whatever the growth that I want from the time of investment. And so assessing what the state of the market is today, what the state of competition is, and where the market is going is also very crucial, right? Like if someone invested in a payments company 5 years before UPI came into existence, whereas someone invested in a payments company 1 or 2 years after UPI came into existence, the fate of the company would be very different. And so assessing the state of market is crucial. The third thing is exactly what you talked about, which is the numbers. So revenue, but also revenue growth, because we're investing in companies that we want to show having faster growth, gross margin profiles, contribution margin, bottom line profiles, and specifically in consumer brands or D2C startups, what are the repeat rates? Because usually you make more money on the second, third, and fourth order. So having the right playbook or the right toolkit to assess these metrics is very crucial. I think gone are the days when startups can burn money for a endless period of time. And so as an investor investing in startups, the two key things that I would ask a startup if it's not monetized is how and when will you monetize? And two, how do you see this business 2 years out, 3 years out, 4 years out, 1 year out, actually exhibiting a P&L that generates some profit? What's the path to that profitability if you don't have it today? Because a lot of them won't be profitable, but as long as they're thinking profit and they want to make profit and they have the idea how they will get to profit, I think you're in a good place to assess the company.
And they say that 9 out of 10 startups fail. So what are some of the major risks when it comes to investing in startups, investing in IPOs, and what should investors keep in mind?
I think I won't mince my words when I say it's one of the riskiest asset classes and the riskiest securities that you can invest in, because the company is still not mature. There will be a lot of change. Business plans on Excel, at least at the early stage, don't necessarily play out. I've been a startup founder. I can tell you that my business plan didn't play out either. And so I think what you see today may not be the state of the company tomorrow, day after, or 1 year out. And so that risk is a very crucial risk. The second risk is that what you're investing in is not liquid at your whim and fancy. Which means today, if you own a listed equity and it drops 20% and you get cold feet and you want to sell that stock, it's in your hands to press the button or pull the trigger and sell the stock. Similarly, if you see a 2x gain in an equity that you've invested in, you can pull the trigger and say, I want to book my profits. Unfortunately, in the startups, the liquidity events are not completely in the investor's control. They don't come more than once or twice a year, in most cases, once every few years. And so, managing that illiquid profile or having a lot of your assets in illiquid form, as well as taking those decisions at that moment, knowing that you won't get that moment for another 1 year or 2 years or 3 years, is a very, very different kind of risk, because you may be seeing 5x, 7x return in a company, but you believe there's more growth potential, so you want to further ride the wave. That next time you get the liquidity outcome, it may be 20x or it may be 2x or it may go to zero, right? And so assessing when to take the liquidity event, given that liquidity events are few and far between, is also a big risk and a big skill that startup investors would need to have.
It's actually interesting because Mark Cuban had said that raising money is not an accomplishment, but it's an obligation. So what do you want to say to this?
I think that raising money has been glorified, and it is obviously in some ways an accomplishment, because when you do go out to raise money as an early stage company, you face a lot of rejection. And so when you get that eventual term sheet, that investment, it is somewhat of an accomplishment. But we have to keep in mind that once you raise money, you are on a treadmill, and you are on a treadmill that's running at the speed or the business plan that you have given your investors. And so you may have been running at speed 6, but when the investor comes on, you move to speed 9 or 12, and you need to consistently run at that speed. And that speed is not completely in your control. There are other factors, investor outcomes, investor returns, that are also kept in mind when deciding that speed. So I think raising money is not for everyone. You have to be okay with that speed, that plan, that investor. And I think the other thing about raising money is, while it can be celebrated for a very short period of time, it comes with a lot of responsibility as well, because you're responsible for somebody else's money. Usually the fund manager is also responsible for somebody else's money. And that amount of responsibility needs to be taken very seriously, and even more than when it's your own proprietary capital, according to me.
Now, a lot of the well-funded companies as well in the non-listed space seem to be burning cash. They want to grow. They're not really chasing profitability. That was the narrative that we saw a few years ago. Things have really changed. Everyone's pulled up their socks. How have things changed? Is this now a prerequisite before listing?
Look, I think there was a time when a non-profitable company could never be listed in India. I think we are seeing certain changes with some amount of leeway and flexibility being given to tech companies that have a path to profitability. Having said that, if that path to profitability is not very clear, the listed market is a much tougher place where you are analyzed on a quarterly basis. Your data is completely public. And so if you are not profitable and your path to profitability is not clear, the stock could get beaten down, just given the amount of public information available. So I would say for consumer companies, for consumer product companies, for D2C brands, I think for a listing, profitability is crucial and probably a prerequisite. But for certain tech-based businesses, there could be some leeway for profitability as long as the path to profitability is very clear.
Right, and given the gush that we've seen in SME IPOs and a lot of issues that have hit the markets, what is it that you think investors should watch out for?
I think there's two ways to do it, right? The first way is to get access to pre-IPO securities, but obviously there is a minimum quantum required, which is on the higher side for pre-IPO securities. So be in the know about how this is happening and when this is happening. If you don't get that, then apply for the IPO. But if it's an IPO with sort of a lot of demand, there is a low chance that you'll get the allocation. But I think even though each of these sort of companies, or a lot of these companies, have an IPO bump where the stock surges for some amount of time, each company goes through its cycle. So if you genuinely believe in the stock and you have a price in mind that you want to buy that stock at, keep that price in mind, and wait for that moment to come. And when that moment comes, you should be able to pick up the security, because at least in the listed market, with startups, things do go up and down, and stocks do get beaten down at times, and those could be good buying opportunities if you believe in the long-term vision of the company.
Any recent IPO, Arjun, according to you, or listing that has really stood out?
So I think Zomato's been a very interesting IPO story because post-listing you've seen a new business vertical being launched or a new business vertical being consolidated with Blinkit, and now we have more businesses come out like District. And I think the other thing that has been very interesting with Zomato is that the team has been behaving like a seed or Series A stage startup, launching new features, launching new parts or aspects of the product. So created a lot of value, but also it's a great company to track how even post IPO they have done lots of innovation and behaved like a startup, which may not be the case with as many companies that we see listed on the stock market. The other thing I would say is that given what's happening with Zomato, I'm very excited to see what happens with the Swiggy IPO as well. So it's something that we'll see very soon, and will be very interesting to see both our sort of food delivery heroes being listed.
Got a quick rapid fire round. One word answers. The future of the startup industry is?
I think very exciting, especially in India.
Top 3 things that you would look at before investing in a startup.
I said it before, founder, scope of expansion of market, and then numbers.
What's the biggest red flag?
Founder motivation is not clear.
Do you have any regrets? One company you wish you put your money in?
Zepto,
Who, according to you, is the best startup founder?
by far Dipinder Goyal.
And as an angel investor, what is the best advice that you can give?
If you miss something, let it go. Because if you continue to regret that, you may make wrong decisions going forward.
Okay, Arjun, it's been a pleasure chatting with you. Thank you so much for being so candid and opening investors' eyes to how to invest in the primary markets, in startups, and play a role as an angel investor. It's been great interacting.
Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from Nirmal Bang.